Okay, so this video is called Your 60/40 Portfolio is Not What You Think It Is. And we're going to show you a perspective of your traditional 60/40 portfolio that will probably surprise you and perhaps cause you to rethink your allocations. So stay tuned for 5 minutes. We think you will find it interesting. So what we do is we look at 60/40 from the enterprise perspective to understand your true bond exposure. When viewed in this light, the actual 60/40 true bond exposure is significantly less than 40%, and so we will show how all this works and then show your actual portfolio risk and provide some ideas to better accommodate your risk preferences. So this graphic shows the enterprise triangle with the various levels of participation that an investor can choose from, with bonds having priority claim at the bottom and equity with the lowest priority on the top. The value of the enterprise includes all the debt and all the equity. Now, here is the key concept. When you invest in equities or stocks, you are buying an ownership interest in that whole triangle or the whole enterprise. And so this means that you also assume, although not personally, the debts of the enterprise. So when you buy equity in a company that has debt, you are assuming that debt exposure. Now, when you lend or invest in bonds, you are long bonds. And when you assume debt or borrow, that is the opposite of lending, investing, or being long. So therefore, borrowing or assuming debt is the same as being short bonds. If you buy bonds, you're long bonds. If you go the other way, that is borrow or assume debt, you're short bonds or short debt. Okay, so understand that basic concept. So when you invest in equities of companies that have debt, you essentially create two risk exposures. One is being long equities and the other is being short debt. So let's look at an example of how it works. For simplicity, assume company SPX represents the entire universe of listed companies. And let's assume it has a market cap of 600,000 and there is debt outstanding of 400,000. And so that would give the entire enterprise a value of $1 million. Now assume that you have a portfolio of $1 million, which is currently in cash and ready to be invested in a 60/40 portfolio. So there are two transactions necessary. The first is to allocate 60% of your cash, or 600,000, to equity, and the second is to allocate 40% to bonds. Now, in transaction one, when you buy the 600,000 in equity, you automatically assume the debt of 400,000 in company SPX. So recall from our previous slide that assuming the debt is the same as being short the debt. So when you buy the 600,000 in equities, you are now long 600 in equities, but you're also short 400 in debt. Okay, that's just from taking the equity position. Now, in transaction two, when you allocate 40% or 400,000 to bonds, now you have effectively neutralized your bond exposure because your equity position made you short 400,000 in bonds, and now you just went long 400,000 in bonds, so your net bond exposure is effectively zero in this case. Now, obviously, the investment universe is a lot more diverse than our simple example, including government bonds, but the point is just to show you at the big picture level, when you take an equity position in companies that have debt, you create a short exposure to bonds, and then if you subsequently invest in bonds, you effectively neutralize that short position that you established on the equity purchase. And the neutralizing impact will depend on the ratio of debt to equity at that time. So when you look at the entire market in the real world, what happens is that the debt to equity ratio is not constant over time. It depends on the value of equities and the amount of debt outstanding, and it changes over time, and this graph shows what it looks like. There have been times when the debt to equity ratio has been as high as 90%. Right now, it's at about 40%. So we looked at a 60/40 portfolio over the past 40 years in light of the debt to equity ratio in the market at each point in time to see what your effective bond exposure was given your short exposure by taking that 60% in equities. And what we find is that your effective true net bond exposure over the 40 years has actually only been 3%. So really that 60/40 portfolio does not have 40% exposure to bonds. It actually only has averaged about 3% true net exposure to bonds. So that will come as a surprise to most people. So you will often hear that stocks in a 60/40 portfolio represent 90% of the risk in the portfolio, and that is true, and it's not because stocks are 8 to 9 times riskier than bonds. It's just that the true net dollar exposure of bonds has actually been less than 10%. So in this case, the dollar allocation does actually approximate the risk allocation. And so this is important because most people think that they're getting a 40% exposure to bonds, but your true net bond exposure is actually a whole lot less. And then we looked at a bunch of different scenarios, including how returns would change if we actually targeted a true 40% bond exposure. And it's quite interesting. The returns were slightly lower, but the risk-adjusted returns were much higher. If you are a conservative investor, you may want to consider targeting a higher true bond exposure. So take a look at the article on our website for a more in-depth view. And so here are some thoughts to ponder on based on this presentation. The first is, should you even own corporate bonds? Because if you are investing in equities, you're going short corporate bonds, why would you then neutralize your position by going long corporate bonds? In other words, by buying corporate bonds. So we think there's no reason to own corporate bonds if you are invested in equities. You should own government bonds instead, which will provide some protection in recessions, which corporate bonds will not provide. The best analogy I can give you is, for example, would you rather pay down your home mortgage or invest in mortgage-backed securities if they both offer the same yield? And if you put it into mortgage-backed securities, it just doesn't make sense. It's just a neutralizing event. You may as well pay down your mortgage. Why put it into another security that simply offsets a position you already have? It's the same thing with buying corporate debt. It's just a neutralizing event, and it doesn't seem like an effective use of money. So the key takeaway here is that viewing 60/40 from the enterprise perspective gives a better insight into your risk profile characteristics and enables you to understand your true bond exposure. And the key to managing risk, of course, is to have a clear picture of what your actual exposure is. For what is undoubtedly the most popular strategy in all of investing, it's a bit perplexing that this perspective has never been presented before. Targeting a true 40% long bond exposure gives a lower absolute return than a traditional 60/40, but a higher risk-adjusted return with much lower drawdowns. So if you're focused on minimizing drawdowns, particularly if you need money for withdrawals, that is very important, so you may want to look at that. So that's it for this presentation. Hopefully we have given you something to think about. Thanks.